Tesla stock has had 6 red days in a row. Let's hope we don't get many more. Here in this video, we will go over a price prediction on what I expect to happen with Tesla stock this week. We'll go over any and all important economic data, and we have the most important data of all, which is the CPI report. We also have PPI this week. I will share with you my expectations for both of these data reports, which have huge implications for Fed policy, for markets, for Tesla stock specifically. We will also go over earnings. It is the official start of earnings season, and Friday's shaping up to be a pretty important day. We'll also look at specifically option activity and option positioning in Tesla stock, and I think that is very important as well. Not to mention, there's something very interesting happening right now. There's huge hedges being put on our markets, or shorting activity that is being done right now. And I want to explain why this could be happening, if this is potentially bullish or bearish. If this is your first time to the channel and you like the deep dives that we do on Tesla stock each and every single day, consider sticking around a while. Hit that like button, not just hit it, tap, tickle, touch, smash it, lick it, throw your phone at the wall. It really doesn't matter, but make it turn a different color. Consider subscribing, and let's get into it. First things first, as I mentioned, Tesla stock has been down 6 days in a row. So if we don't get a bounce this week, your technical indicators are going to be, well, even more bad than they are now. The RSI is under neutral, getting close to being oversold at 43.71. This is rough. That's a rough number for Tesla. Now, could it get worse? Obviously, but typically, you would expect to see a bounce in some capacity or another when the RSI is in the low 40s. Now, we will explain throughout this video why stocks have been falling recently. Tesla is not the only stock. This is one of the worst starts to any year that we've ever seen. But a lot of it comes down to profit taking, hedging, and worse economic data than what some people were hoping for. If you take a look at this chart, this is from the Crowded Market Report. You can see here in blue the sum of large speculators, which is positive, but the sum of commercials, this would be like big firms, right? This is one of the most short levels they have been in a very long time. This chart goes all the way back to January of 2022. Now, it's normal to see a lot of this shorting activity during the start of a new year. It's not uncommon. And what I'll say here is we have an election in 2024. We have the first Fed rate cut, which historically is not good because historically we go into recessions, and that's why the Fed is cutting rates. So it doesn't have to be some kind of big crash when the Fed does cut rates. But historically speaking, that is usually not a good thing for the markets. You also have a toss-up between recession or no recession. So what this looks like to me, and you've probably seen this chart floating out there, it just seems like there's a lot of prudent hedging that is happening right now. A lot of big money is hedging for a potentially volatile 2024. This is another reason why stocks probably have been selling off recently. But this could actually be bullish because if a lot of funds are going short right now, well, if the worst possible scenario does not happen, well, usually the majority is not correct. If everyone is short, usually stocks rally. If everyone is long, usually stocks fall. That's just kind of how the markets work. So when I actually see this, I think this is pretty bullish. Again, as long as we don't have a black swan event or anything crazy happens. EJ and Tony on X says the December jobs report. There's so much bad news under the hood of this report, including the economy shedding 1.5 million full-time jobs in a single month, big downward revisions, and a true unemployment rate between 6.4 and 7.5%. Here's the truth you should know. So you're basically getting all of your jobs reports that are getting revised. If you look at the actual total change in payroll reports throughout 2023, that you will see a big downward benchmark revision down, big time. Instead of the over 3 million jobs we thought we added, it's under 2.5 million jobs. That's not exactly great. And this is probably why stocks did poorly overall since the jobs report. Something else that has recently been spooking investors as well was the ISM services employment. You can see here, this was 08, 09. You've seen a big drop here. And during 2020, you've seen a big drop here. Well, you just got your big drop. So who knows? Maybe this is a head fake. But historically, when you get big drops like this, it's not great. You're actually lower now than you were during the dot-com bubble. But as you know, history does not always repeat, but it usually does rhyme. So it's not like we're heading into this awesome labor market in 2024. That's not the case, but people still do have jobs, and that's the most important thing. When the economy is 70% consumer-based, people buying things, products, goods, and services, well, it's okay as long as people have their jobs. This is something we want to watch pretty closely over the next couple of months, because if we go into a recession, stocks are not going to do well. If we avoid a recession, stocks are going to do very well. And depending on Fed policy, well, that increases the odds of a recession if the Fed waits too long to cut rates, or if the Fed starts cutting rates sooner, then that means maybe we might avoid a recession after all. Now, some people have started to argue, this is an argument that I have made for over 6 months now, that we've been in a recession. We've been in a rolling recession. Commercial real estate, if you look at goods just as a whole, people are not buying discretionary, goods. Chips in late 2022, early 2023, that was in very recessionary kind of environment. If it wasn't for the AI revolution, who knows where Nvidia or AMD would be right now. So manufacturing, that's been negative for like 24 months straight. There's been different sectors of our economy that have already felt recessionary dynamics and pressures, but it's just not happened at once for all of these different industries. So we're not technically in a defined recession, but maybe we've been in a recession for a while now. This will all make sense when we look at the earnings calendar and the economic calendar, because all of this plays together for this upcoming week. So on Friday, January 5th, the non-farm payroll report actually came in 216,000 jobs. The estimate was 170,000 jobs. So on face value, it looks like the labor market is doing just fine. Now, there was a lot of those revisions like we just mentioned, but what you'll actually find interesting is while stocks did not do well overall, for March, the odds of a rate cut actually rose on Friday. You would think if the jobs report beat by almost 50,000 jobs, the odds of a March cut would actually fall. No, that's because I think a lot of the fear right now is not an overheated economy or labor market, but potentially an economy heading into a recession. As you can see, the odds of a rate cut in March went from 60.5% to 64%. No matter if we see 10 rate cuts or 2 rate cuts in 2024, stocks will do well or poorly based on one thing, whether we go into a recession or not. If we go ahead and take a look at the week ahead and the economic calendar, Monday and Tuesday are pretty dry. Now, we are going to get Fed Bostic that speaks at 12:30 p.m. on Monday. What we heard from Fed Logan over this weekend was that the Fed should start to reduce the amount of their balance sheet reduction. And the Fed is currently reducing their balance sheet about $90 billion. Historically, if the Fed reduces their balance sheet, stocks do poorly. If the Fed adds to their balance sheet, stocks do well. We can see this time and time again throughout the history of the Fed's balance sheet, which really is kind of a new concept anyways, ever since like 07, 08, when the Fed started buying assets. Any period of time this is going higher, this chart is going higher, stocks tend to do well. Anytime the chart's going lower, stocks tend to do poorly. Now, we've been going lower from 9 trillion down to 7.6 trillion. But stocks are at all-time highs. Why is this? Well, money is pooled into Magnificent Seven names, which have the largest weighting in the S&P 500. If you look at a PayPal, down from $300 at the high to $58 today. If you look at Fubo, from $40 to $3 today. If you look at Tesla, from $415 at the high down to $230 it's clear the average stock has not done well. If we can slow the pace of balance sheet reductions, and other Fed officials like Fed Bostic on Monday and others throughout this week reiterate the same thing Fed Logan just said on Saturday, well, that should be great news for stocks. We'll talk about that more when we get into what I actually think will happen this week and where I think Tesla stock will go. But that's one thing that should be pretty good news. On Monday, we will also get consumer credit change. This is expected to be in between $9 and $11 billion. The higher, the better, typically, because that means people spend more money. That could be a good sign for earnings that are right around the corner. Now, on Tuesday, you're not going to get much at all. You are going to get a 3-year bond auction economic optimism index coming out at 10 o'clock in the morning on Tuesday. But really, Tuesday is going to be one of the slower days for sure. Wednesday, you have a lot of oil data. You are going to have Fed Williams that speaks at 3:15 p.m. But again, another slow day on Wednesday. On Thursday, this is where things really start to heat up. You get your inflation report. Now, I'll just bottom line this real quick. I think inflation is going to come in lower than expectations because expectations are pretty high right now for some of these measures, especially your headline. Headline month over month for December is expected to be 0.2% month over month. Last month, you were at 0.1%. And you've actually been at 0%. I believe the month before October was 0%. I believe. Don't quote me on that, but I believe so if my memory is correct. So you're expecting this to jump quite a bit, 0.2% month over month. A lot of this is dictated by oil. I personally have not noticed a rise in gas prices. Gas prices have continued to fall and then really just stayed low here, at least where I live in Michigan. So we'll see how that data is collected. It's collected 3 times in any given month, the beginning, middle, and the end of the month. So depending on what days the data is calculated, that can obviously change things. Now, your year over year headline is expected to increase as well from 3.1% to 3.2%. I think at bare minimum, we come in at 3.1%, potentially as low as 3% or 2.9%. So that's something I definitely feel strongly in, that inflation is not reaccelerating, that it's probably going to continue to decelerate. Now, core inflation month over month and year over year, you're expecting that to get a little bit better month over month, but I think it might get a lot better month over month. So core month over month is expected at 0.2%. Last month was 0.3%. I think you could come in at 0.1%. Now, that might be optimistic a little bit. It really depends on car prices and it depends on housing. But that's just where I'm thinking. I'm leaning more towards inflation is plummeting. We're heading closer to deflation. If the economy is actually weakening and Walmart's been correct, Dollar General, Target, all of these different earnings reports that we've heard over the past, 30, 60 days or so, is any indication of anything, it's that deflation is coming. So I think that might start to show up in maybe some of the core as well here. But we'll see. Obviously, that's not a guarantee, but expectations probably too high for the core as well, in my personal opinion, especially year over year. So year over year, last month came in at 4%. Now you're expecting 3.9%. So not much of a fall here. I think this could come in at 3.8 or even 3.7%. Anything obviously higher than these numbers across the board is going to be very bad news. Because if inflation falls faster than expected, the Fed can cut rates more with a strong economy, right? But if inflation continues to be stubborn and even potentially go higher as some people are forecasting, then the economy is going to have to be even weaker without rate cuts, because the Fed is not going to let inflation come back like they did in the 80s before Paul Volcker. They are going to sacrifice the economy before they sacrifice letting inflation become entrenched. So for obvious reasons, that will be very important. The initial jobless claims number will also be important. This is because it is for the week ending January 6th. We're expecting 215,000 claims. This is more of a leading indicator. So if this spikes big time, well, that's not too uncommon, because after Christmas, a lot of seasonal hirees tend to get laid off. But if you see like a big spike, that would obviously not be great news at all. You will get a 30-year bond auction coming out at 1 p.m. on Thursday as well. That will be important. It's not correlated to Fed policy at all. It's more where the markets just expect rates to be over the next 30 years. So the yields can definitely move around on that quite a bit. And then on Friday, you are going to get PPI month over month. You're expecting an increase to this as well from 0% last month to 0.1% in December. Core PPI is expected to see a big increase from 0% to 0.2%, and core PPI is expected to stay unchanged at 2%. I personally think these estimates are way too high. Even if things rise on core PPI month over month, it's probably not 0.2% from 0% last month. If that happened, obviously markets might not take that as great news, but I just don't think that looks very likely. Now, Fed Kashkari will also speak at 10 o'clock in the morning. And remember, it's all about what is the Fed's narrative from here. Fed Logan really shocked a lot of people over this weekend, saying the Fed should reduce the size of their balance sheet runoff because not a lot of people were expecting that as of right now. But it really just comes down to the simple fact banks are running out of excess capital. We talked about this in the last video, but the reverse repurchase agreement market, this is basically where banks store their excess money overnight to collect a very small interest rate, right? To collect very small amount of money. They put this money here because banks are only allowed to do two things with their money. They are allowed to give out loans to people. They are allowed to buy treasuries. But if the bank, wants to keep their capital liquid, they don't want to go buy 2-year bonds with all of their excess money. What do? They park it with the Fed overnight, collect a small interest rate so they can, continue to fund operations or give out loans or do anything else, right, that a bank would do. They can't lock up trillions of dollars, hundreds of billions of dollars if they might need that tomorrow, right? Then they're in the situation which SVB was in. They bought a lot of long duration treasuries. Those treasuries lost capital, lost money, lost value, and then they were forced to sell and boom, kaput, you went bankrupt. So what the Fed's basically saying is when this gets too low, there's not going to be anyone that's going to buy the $90 billion of bond runoff that the Fed is doing, right? The Fed owns $9 trillion. Well, used to own $9 trillion worth of bonds. Now they own still over $7 trillion worth of bonds. If they continue at this pace, the banks are going to run out of excess money to buy all of those bonds. So in order to do this for a longer term, they're going to have to slow down the pace, probably down to 10, 15, 20 billion a month, which would be pretty dramatic in terms of potential stimulus to our markets. Now, if we take a look at earnings for this upcoming week, this is the official start to earnings season. We don't have much really at all this week. You can take a look here. You can go ahead and follow us on X. The account is Michael Tyler. Just do Tesla Michael Tyler. It'll come up. Some people say it's hard to find the account, but it should be pretty easy. Now, on Monday, you're going to have Jefferies that reports in after hours. Typically, that doesn't move the markets much at all. Tuesday, bunch of earnings. None of those are going to be important. Wednesday and after hours, though, you have KB Homes, and that will be semi-important for the markets. Given what's going on with real estate, that's the main segment we still have inflation in. More houses being built, the better. More demand, potentially the better. That would show the economy is doing well, but maybe too hot. We'll see. There could be a lot of potential implications that I don't want to speculate too much, but that's one that you want to pay attention to. You want to see how the consumer is doing. You want to see if the consumer is still buying homes. Even if it doesn't move the markets, that's something I will be paying very close attention to because that's one of the first places that really would slow down. If people are worried about losing their jobs, they're going to not buy that new expensive home, right? Now, Friday is going to be the big day. You're going to have JP Morgan, United Health Group, Delta, Bank of America, Wells Fargo, BlackRock, Citi, BNY Mellon, and WePro. The banks here. We want to see how the banks are doing. What the banks say about the economy, about the consumer, about their own business. That's going to give us a lot more insight. Now, all of this data, all of these earnings will have an effect on 10-year Treasury yields. 10-year Treasury yields have been rising quite a bit recently from 3.78% on December 27th. Guys, it's January 7th, and you are now at 4.05%. you are up about 25, 26 basis points in just a couple of trading days. That's quite a bit. That's the equivalent of a rate hike in 10-year Treasury terms. A lot of people thought we would not get back above 4%. This is a big reason why stocks have been falling. And just if things go as I expect, inflation comes in weaker than what the markets are currently forecasting, and maybe earnings are decent, Treasury yields are going to plummet. If earnings are bad, if banks have bad things to say, and inflation comes in weaker than expected expectations, then yields will really start to fall. And that could have a positive effect on stocks also, but earnings coming in negatively, well, is not going to be good. I think the single biggest thing for this week is obviously inflation and the CPI report, and that's probably going to dictate how we trade for the rest of this week. Thursday and Friday, and then the start of the following week. And the inflation report has a direct correlation to the dollar. The dollar rises as the markets are interpreting less rate cuts, a more aggressive Fed. That's why 2022 was so rough across the board. The dollar just continuously rose. When the dollar rises, stocks fall. When the dollar falls, stocks rise. Why is that? Well, because if you're a multinational company, which a vast majority of the weighting of the S&P is, like a Tesla, they take in foreign currencies around the world. Apple takes in foreign currencies around the world. Google, Microsoft, Amazon, right? You get it. When the dollar is strong, those foreign currencies convert to less dollars. When the dollar is weak, those foreign currencies convert to more dollars. So it fundamentally directly affects company earnings. The higher the dollar goes, the more pressure on company earnings. The lower the dollar, the more earnings are helped out. Well, you could see this back in July, right? During kind of the April through July rally in the markets, the AI rally this past summer, the dollar was falling, especially in July when things really started to kick up a notch. Well, the dollar bottomed around July 13th. The dollar started to rise. What happened? Stocks fell big time on the S&P 500, and the dollar just continued to rise. What has happened since? Stocks started to perform well in November and December. The dollar was falling. What's happened recently? The dollar has been up or flat 1, 2, 3, 4, 5, 6, 7 trading days in a row. No surprise. The S&P 500 has been weak since the start of 2024. I mean, we've had 1, 2, 3, 4 red days in a row, and Friday was barely a green day. So if inflation comes in weak, maybe the Fed continues to say what Fed Logan said, well, the dollar should fall. And that should be great news for stocks. Now, if we take a look at Tesla's option activity, even though there's been 6 days of red in a row, hedge funds and institutions have been pretty positive, pretty constructive on Tesla as far as what their dollars are saying. Over the past week, you've had 3,500 orders totaling $10.54 billion with a positive order value of 56%. On Friday, you had 458 orders totaling $1.61 billion with a positive order value of 68%. Now, heading into this week, we have open interest to the call side of 55.69%, open interest to the put side of 44.31%. So off face value, there is more calls than puts. Generally speaking, that's a good thing. If we actually take a look at the option activity itself, you can see a lot more big green circles here than big red circles. So just looking at this arbitrarily, it looks positive. Now, as far as the strikes with the largest amount of activity, that's definitely going to be the 250 call with volume on Friday of 31,403, open interest of 12,000. The 255 call has a lot of activity as well with volume of about 22,000, open interest of 10,000. The 240 call, though, had a lot of activity as well with volume of 37,000, and open interest of 6,300. The 240 put had volume of 17,000, open interest of 6,000, and beyond that, everything starts to really decrease. So lots of activity this week for the call side. So we'll see how things ultimately play out. But if you're just looking at the option activity itself, you would have to say this week looks a little bit more bullish than bearish. I mean, these big green circles are a lot more prominent than the red ones. So if we look at Tesla stock, we're back in this demand zone in the 230s. In the 230s, there's a lot of demand ever since we had the gap up on November 13th, and Tesla stock went up 4% that day. The next day, Tesla stock went up 6%, put us in this 230 level, and we've seen a lot of demand anytime we've come down to the lower 230s, right? You tend to get bought up pretty much right here. Now, for a while there, we were fluctuating between support at the 50-day moving average and resistance at the 100-day moving average. It looks like that is happening again. On Friday, you precisely, like down to the penny, bounced at the 50-day moving average, and you found some resistance at 240. So I would imagine that continues at the bare minimum. At the bare minimum, you probably continue to find support at the 50-day moving average around 235, and you'll find some resistance around 240. If you can get above the 100-day moving average at 240, 148, that's where things get a little bit more exciting again for the upside move. Now, for this week being a little bit more conservative, just given our big earnings are on Friday, CPI is going to be on Thursday, Monday, Tuesday, Wednesday, we don't have much that is happening for our markets besides the Fed and the Fed narrative. If that starts to take hold in the beginning of the week, I think Tesla stock could rally back to about 246. That looks like the peak of this this period of time, right? This sideways trading period from November 14th through December 13th, about a month. You kind of traded sideways here in this $20 range. You were getting a lot of resistance here around 246, almost 247. That would be in the range in which I would expect Tesla stock could trade up until Thursday and Friday, until we get the big data. If the big data comes in good, then Tesla stock could make its way back into the low to mid 250s this week. If not, then Tesla stock comes back down to trade in the 230s. So I am expecting a rally in the beginning of the week based on 6 red days in a row, a bounce back, and the talk of the Fed potentially starting to think about reducing the size of their balance sheet runoff. I think these will have positive effects, potentially send the stock into the lower mid 240s before we get the CPI report. And if the CPI report is good, then I think Tesla stock rallies into the 250s. If it's really good, Tesla stock could rally more than that. But I think this is pretty conservative, pretty logically speaking. I think it's pretty sound. If things are bad with the CPI report, then Tesla stock probably comes back down into the low 230s. And you probably find support again around the 50-day moving average. If something unprecedented happens, your 200-day moving average is right at 230. So I would expect to find support there. If you don't, then you got a gap to fill down to about 220. So I do think your downside is pretty limited here, whereas your upside could be exponential, especially if you're just buying and holding Tesla stock. I wouldn't even think about the week-to-week price action. But, I mean, some big gains potentially coming in 2024. Again, if we avoid a recession, that's where we get the big gains. If we go into a recession, well, I don't expect Tesla's going to do much. Tesla could probably close 2024 about the same pricing that we're at right now, but that's not my expectation. So again, I expect a rally in the beginning of the week, and then I am expecting a further rally if CPI is good. If CPI is bad, I think that takes us right back to roughly where we are now. So let me know what you guys think about this information down below in the comment section. Let me know your thoughts on this week and over the next couple of weeks. We may or may not be getting the India factory announced this week. If that happens, then Tesla stock could make a much larger move, maybe into the high 260s, 270s again. We want to see if, again, around 260 or so is resistance. If you break out above that and it's not much resistance, then potentially we could rally even further than that. The Indian factor is something even a lot of your biggest bears have been waiting for a long time to address the more mainstream mass market besides just China, Europe, the US, Australia, South Korea, Japan, right? All the other countries, well, they really can't afford Teslas in the way that they are currently. So that's also potentially going to be important if that does happen. If you look at the MACD as well, the MACD has been curling downwards, which is not exactly great. You're almost in negative territory again. Looks prime for a bounce. Same thing with the RSI at 43.71. So thank you for watching, guys. If you guys want to come trade with us live in real time, hopefully have a great 2024 as we did in 2023. Well, check out that link down below in the description of this video. Thank you for watching. My name is Michael Tyler. Enjoy the rest of your day, and I will see you in the next one.